Okay, let's unpack this. If you've ever looked at a financial chart, and felt sort of whiplashed by all the constant erratic movement.
Oh yeah, those wicks jumping all over, the colors flipping back and forth.
Exactly. That visual clutter, it's a huge problem, isn't it? It leads to false signals, confusion, and often uh, scares you out of a profitable position way too early.
It really does. That noise can be overwhelming.
So today we are diving deep into a technical analysis tool, a really clever one, designed specifically to, filter out that unwanted noise. It's the Heikin-Ashi Candlestick chart.
Heikin-Ashi. Sounds interesting.
It is. And the name itself kind of tells you what it's aiming for. It's Japanese. Heikin means average or balance. And Ashi, well, that means pace or bar.
Average bar. That's
That was an average
what?
bar technique.
Mhm.
And what's fascinating is this isn't some newfangled thing. It was developed way back in the 1700s.
1700s. Wow.
Yeah, by Moneshima Homa. He's actually the same guy credited with inventing the standard candlestick chart we all know.
Okay, so it has a long history. What's the core difference then compared to the regular candlesticks?
Well, you could say the difference is almost philosophical. Standard charts plot the raw, unfiltered open, high, low, and close the actual OHLC prices for that moment.
Right, the pure data.
Heikin-Ashi, or HA, this is what we'll probably call it, it modifies those values. It uses calculations that pull in data from the previous bar.
Ah, says looking back a bit.
Exactly. And the whole mission is simple. Create a simpler, smoother chart. One that helps you spot the underlying trend more easily, and maybe more importantly, helps you stay with that trend.
That smoothing effect. That's got to be key.
It really is. That's the core insight.
Yeah.
But when you average data like that, you're inherently making a trade-off, right? You must be giving up some real-time accuracy for that consistency.
That's precisely the deal. It's an explicit trade. You give up that high-fidelity, second-by-second precision of the current price action.
And what do you get in return?
Enhanced clarity, much clearer trend identification. You accept a slight delay in the signals, but you get much cleaner visual confirmation in exchange.
Okay, so it's clarity over immediacy. Let's get into how it achieves that.
Yeah.
That smoothing isn't magic, it's math, right? Dependent on that previous bar.
Exactly right. It's pure calculation. HAA replaces the standard OHLC with 4 averaged values. Now, you don't need to memorize the formulas, but understanding what each one does is crucial.
Got it. Let's walk through them.
Okay, so the HA close is probably the easiest one. It's just the average price at the current bar. You take the current open, high, low, and close, add them up, divide by 4. Simple average.
Okay, average price of the period. Straightforward.
Yeah, it gives you a kind of central point of the period's activity.
But the real noise filtering, the clever stuff, happens with the other 3 values, right? Especially the HA open. That's the one that visually gets rid of those price gaps we see on normal charts.
Absolutely, that's the trick. The HA open isn't the actual open price. It's calculated using the midpoint of the previous HA candle's body.
The previous one, how?
Specifically, you average the previous HA open and the previous HA close. So previous HA open plus previous HA close too.
Ah, okay. So each new candle starts halfway up or down the body of the last one.
You got it. And because of that, you get that visual continuity. It smooths over those sudden price jumps or gaps that can cause so much confusion on traditional charts. That smooth connection is really the secret sauce for cutting down false signals.
Interesting. Okay, what about the high and low? The HA high and HA low, do they still show the true range?
They do, yes. They make sure the candle still reflects the actual price extremes reached during the period. The HA high is the highest value among 3 things: the actual current high price, the current HA open we just calculated, or the current HA close.
Whichever of those 3 is highest becomes the HA high wick.
Exactly. And the HA low is the flip side, the minimum value of the actual current low price, the current HA open, or the current HA close.
Okay, so the wicks still capture the true extremes even while the body is averaged.
Correct. It ensures you don't lose sight of the period's volatility, even with the smoothing.
But hang on, if the HA open depends on the previous HA bar, what about the very first candle on the chart? There's no previous HA data. That sounds like a bit of a chicken and egg problem.
Yeah, that's a classic point. The very first candle calculation is often handled slightly differently. Sometimes the HA open for that first one is just simplified, maybe just the average of its own actual open and close, O plus C2.
So it's a bit artificial at the start.
A little, yes. But that initial effect, it washes out really fast. We're talking usually within, say, 7 to 10 periods. After that, the continuous averaging takes over, and you get that smooth, directional picture we're looking for.
Got it. So that initial quirk fades quickly. And these visual differences, the smooth bars, they become our signals for reading the market.
Precisely. Because the chart is filtered, the signals tend to be much clearer.
So the basics, green or hollow candles mean the HA close is higher than the HA open. That's bullish, uptrend. And red or filled candles mean the HA close is lower than the HA open. Bearish, downtrend.
Standard candlestick color logic just applied to the averaged values.
But the real power, you're saying, comes from reading the shadows, the wicks, or sometimes the lack of wicks.
Absolutely. There are about 5 primary signals you look for that tell you about the trend strength and, critically, whether its momentum might be weakening.
Okay, let's break those down. What are the key takeaways?
Well, the big distinction is between a strong trend and just a standard trend.
All right, strong uptrend first.
For a strong uptrend, what you're looking for are consecutive green or hollow candles, but crucially, with no lower shadow or wick.
No lower wick at all.
None. Or a tiny one, maybe. This is often called a shaved bottom. It signals really strong, dominant buying pressure.
And the message there is?
The message is pretty clear. Stay long. Let those profits run. Don't get shaken out.
Okay. And the opposite. Strong downtrend.
Same idea, flipped. You're looking for consecutive red or filled candles with no upper shadow or wick. A shaved head. Intense, continuous selling pressure. The signal there is stay short or get short if you're not already.
So shaved candles, top or bottom, mean extreme one-sided momentum. What if there are shadows?
Right, so the appearance of a shadow indicates some pushback, a slight reduction in that absolute strength. A standard uptrend will still show green candles, but they might have lower shadows now.
Still bullish, but maybe not pedal to the metal bullish.
Exactly. And a standard downtrend shows red candles, but they might have upper shadows. Still bearish, but sellers aren't having it completely their own way anymore. These are still trend-following signals, but you're aware the momentum isn't quite as pure.
Okay, that makes sense. Strong versus standard. What's the fifth signal? The warning sign.
Ah, yes, signal number 5. Trend change or indecision. This is key. What you see here are candles with small bodies, but long upper and lower shadows.
So looking kind of like a doji or a spinning top on a regular chart.
Exactly like that. Small body, long wicks sticking out both ends.
And this means?
This is crucial. It signals that momentum is fading. Buyers and sellers are reaching an equilibrium, the markets become uncertain. The trend might be losing steam.
So potential reversal coming.
It may foreshadow a reversal, yes. But, and this is critical, Howard, you absolutely should not act on this signal alone. It's an alert, a yellow light. It signals indecision, not a guaranteed reversal. Confirmation is vital.
Right. Don't jump the gun just because you see a spinning top. Okay, so we know the signals now. Green, red, shave, shadows, indecision candles. But seeing a red candle turn green? That's not the whole story, especially with that lag we talked about.
Oh, right.
How do we translate this visual clarity into actual practical entry and exit timing? If we're potentially entering a bit late because of the averaging, doesn't that lag hurt performance, especially for faster traders like scalpers?
That's a really fair point, and it goes back to the core trade-off. The strategy with HA prioritizes confirming the trend and staying with it over trying to nail the absolute bottom tick for entry or the top tick for exit.
So you're aiming for the main body of the move, not the extremes.
Precisely. For entering a trend, you typically wait for that undeniable confirmation. A clear color switch, say red to green, may be reinforced by the appearance of the first shaved green candle. That shows strong conviction returning.
Okay, wait for the clear signal, maybe even the first shaved candle. Then what? How do you manage the trade?
Once you're in, the holding strategy is where AJ really shines. You basically maintain the position as long as that dominant color persists, especially during those sequences of shaved candles.
So the shaved candles tell you to be patient.
Exactly. This is what helps prevent getting spooked by minor pullbacks or volatility that would look like big, scary reversal bars on a traditional chart. HA smooths that out, keeps you focused on the main trend direction.
Okay, that's powerful for staying in. So when do we get out, or at least pause and reassess?
An exit or pause signal usually comes from 2 things. One is an obvious change in candle color green switching back to red, for example.
Makes sense.
Or, perhaps more subtly, the sustained appearance of those small-bodied 2-wick indecision candles we mentioned, the dojis or spinning tops.
So a few of those in a row.
Yeah, if you start seeing a cluster of them, it tells you the market is stalling out. The trend is potentially exhausted, or at least pausing significantly. That's your cue to consider taking profits, tightening your stop, or maybe even exiting.
And again, about those indecision candles.
Hmm.
You stressed confirmation earlier.
Absolutely critical. I have to repeat this. Those patterns show indecision within the trend or at the potential end of it. They don't guarantee an immediate reversal.
So what does confirmation look like?
A disciplined trader needs more. Maybe you identify a key prior support or resistance level. You see the indecision candles form near it, fine. But you wait for the next candle to actually break that level in the opposite direction before acting. Or wait for a clear color change after the indecision.
Got it. Wait for the follow-through. Don't anticipate based just on the indecision candle itself.
Exactly. Patience and confirmation are key with HA, especially around potential turning points.
Now, one thing that seems quite appealing is the flexibility. Sources suggest HA works across different time frames pretty well, almost time frame tolerant.
It generally is, yes. The mathematical averaging principle works the same whether you're looking at a 1-minute chart or a weekly chart.
So how would different types of traders use it?
Well, scalpers or day traders might use, say, 5-minute or 15-minute HA charts. They're looking to capture those smoothed out short-term fluctuations. And actually, that superior filtering is interesting. Some researchers apparently use HA charts for training neural networks for trading.
Really? Why?
Because it significantly reduces the random noise interference that can confuse the learning algorithms. It gives the AI a cleaner signal to learn from.
Fascinating. Okay, and for longer-term traders?
Swing traders would probably use 1-hour, 4-hour, or daily HA charts to ride broader trends over several days or weeks. And position traders looking months or years ahead could use weekly and monthly HA charts for that really long-term, smoothed perspective.
So versatile across styles, but like most indicators, especially smoothing ones, it's probably best not used in isolation, right? You wouldn't trade only based on HA colors and shadows.
Absolutely not. That would be risky. HA works best when you combine it with other complementary technical tools. It significantly boosts the reliability of your signals.
Like what? What pairs well with Heikin-Ashi?
Classic indicators work great. For instance, overlaying moving averages, MA, is very common. If you see strong green HA candles consistently forming above a rising 50-period moving average, that's powerful confirmation of your uptrend.
Okay, using MAs for trend context. What about oscillators?
Definitely. You can use momentum oscillators like the Relative Strength Index, RSI. If you see those indecision candles appearing while the RSI is way up in overbought territory, say above 70, that adds weight to the possibility of a reversal.
Or oversold below 30 for a potential bottom?
Precisely. Or you could use the Meiji indicator. Look for a Meiji crossover signal happening around the same time as a Heikin-Ashi color change. That confirms the shift in momentum and trend strength.
So layering indicators for a confluence of signals. That makes sense. It reduces the chance of acting on a single false signal from any one tool.
Exactly. That combined approach dramatically minimizes false signals and increases your confidence in the trade.
Okay, so if we summarize the big upsides here, it's clearly superior noise reduction. It filters out that unwanted market entropy, which is valuable whether you're a human trader or apparently a trading algorithm.
Yes, the filtering is paramount.
And that leads to enhanced trend clarity. It's just easier to see the main direction and stick with it. Plus, you mentioned pattern recognition.
Right. Sometimes classic chart patterns like wedges, triangles, or channels can actually appear more clearly defined on an HA chart because the noise that might obscure the pattern's boundaries on a traditional chart has been smoothed away.
So overall, high chart readability, reduced false signals. Sounds pretty good.
Those are definitely the main benefits.
But now we have to pivot back to that fundamental trade-off we started with. Clarity costs you something, and that costs precision. Since we're doing a deep dive, what are the critical caveats? The downsides traders absolutely must understand before they rely heavily on these charts.
Okay, yeah, this is crucial. There are really two major drawbacks, and they both stem directly from that averaging process. First, as we've touched on, is the lagging nature.
The signals are delayed.
Correct. Because HA uses past data in its calculations, the signals, the color changes, the shaved candles appearing, they will inherently happen after the actual price has already started moving.
Which means
your entry points might be slightly later and your exit points might be slightly later compared to using a raw price chart. You might miss the very first part of a move or give back a bit more profit at the end. You're potentially leaving some money on the table in exchange for that smoother ride and confirmation.
Okay, lag is the first major caveat. What's the second? You said it was maybe more critical.
Yes, the second one is the loss of actual price information. This is really important.
What do you mean by loss?
The Heikin-Ashi bars, their open high-low close values, do not represent the actual market prices for those points in time, especially the open and close. Remember, the HA open is calculated from the previous bar, and the HA close is an average of the current bar's OHLC.
So the price shown on the HA candle isn't necessarily where the market actually traded or closed.
Exactly. The actual closing price of the period could be significantly different from the HA close value you see, and HA completely obscures price gaps between periods because of how the HA open is calculated.
Wow, okay. That seems like a big deal, especially for execution. How can you set an accurate stop loss or take profit if the HA price isn't the real price?
You can't, really, not based solely on the HA chart values. Trying to place a precise stop loss based on the HA low, for instance, is unreliable because the actual low might have been different. This is a major challenge, particularly for strategies requiring precise execution like scalping.
That does sound like a big hurdle. How do traders who use HA get around that? How do they manage stops and targets accurately?
The common fix is procedural. It's about using the right tool for the right job. You use the Heikin-Ashi chart for the high-level strategic decisions, identifying the trend, deciding when the trend looks strong or weak, getting your entry and exit signals.
So HA for the what and when.
Right. But when it comes time for the actual execution, placing the order, setting the precise stop-loss level, the where you need to see the real prices. So traders will often temporarily switch back to a traditional candlestick or bar chart just for that moment.
Toggle between chart types.
Exactly. Check the standard chart to find the actual recent low or high for your stop placement or the actual current price for your entry. Then place the order based on that real data. Then maybe switch back to HA to monitor the trend's health. You need both views, effectively.
Okay, that makes sense. Use HA for the signal, standard candles for the execution price. Good tip. Any other major limitations?
Yes, one more related to market conditions. While HA is fantastic in clearly trending markets, strong uptrends or downtrends, it's less effective and can even be misleading in other environments.
Like what kind of markets?
Sideways, range-bound, or really choppy, non-trending markets. In those conditions, there's no strong directional momentum for the averaging formula to latch onto and smooth out effectively.
So what happens on the chart?
The smoothing effect can actually generate false signals. It might start showing a sequence of green candles suggesting an uptrend is beginning, when really the market is just bouncing around randomly within a range. It struggles to differentiate minor noise from a real trend when there is no real trend.
Okay, so it needs a trend to work best. Use with caution in choppy or sideways markets. Got it.
Definitely. Know your market condition.
Right. So that really brings us back full circle, doesn't it? We've established Heikin-Ashi is, well, it's a really powerful visualization tool. Its main job is to trade that short-term, often chaotic precision of raw price bars.
For the benefit of long-term, stable clarity, a smoother journey through the market's trends.
Yeah. And that trade-off itself raises a really important question for you, the listener, as you think about applying this.
It forces a choice, essentially. Heikin-Ashi explicitly sacrifices the fidelity of real-time price data to gain that advantage in trend identification and smoothing.
So when you're analyzing any market, you're faced with this fundamental choice. Do you want the potential chaos that comes with absolute precision, or do you accept the delay that comes with enhanced clarity?
Which of those trade-offs, clarity or precision, is actually more critical for your specific trading goal right now? Answering that question will really guide which type of chart or which combination of tools is right for your analysis. Something to think about.